accounting textbooks often have several pages distinguishing between financial accounting and managerial accounting. I like to say financial accounting answers the question, how did you do? And managerial accounting answers the question, how are we doing? So in real time, we give management information that it needs to run the business. And one of the first things we're going to look at is how much does it cost us to make our stuff? We got to know how much it costs us to make our stuff so we know how much to sell it for. And for now, the simple rule is going to be any costs incurred inside the factory are product costs. They're going to be included in the cost of our making our things. Whereas costs incurred outside, such as in the store or in the corporate headquarters, those are period costs. And how we're going to treat those differently? Well, period costs will go right to our income statement, selling, general, and administrative expenses, and they'll get subtracted when they're incurred, whereas product costs will hang around in inventory until we actually sell them. And then we'll do our favorite journal entry, debit cost of goods sold, credit inventory. And speaking of inventory, when we make stuff, we're going to have three different kinds of inventory. We're going to have the stuff we're going to work on, the stuff we're working on, and the stuff we finished working on. Okay, let's pretend we have a factory that makes surfboards. And let's just do a little practice here to see if we know the difference between product costs and period costs. So what about the wood that we use to make the surfboards? Is that a product cost or a period cost? Well, it's a product cost. We're going to include it in the cost of our surfboard. What about the wages of the workers who shape the surfboards, the men and women who actually hands-on work on the surfboards? Well, that's going to be a product cost as well. What about wax applied to the surfboards? Well, that's part of the product cost. It's a little different than the wood. We're going to be able to keep track of that pretty easily. But the amount of wax that gets applied to every surfboard, we're probably going to call that indirect materials, but it certainly is a product cost. And what about salaries to factory supervisors? That's a cost inside the factory, so it's a product cost. It's a little different than direct labor, these people that are working on the surfboards directly, but it's certainly a product. And what about rent on the factory? Any cost incurred inside the factory is a product, which is different than rent on the corporate headquarters. Nobody makes anything in the corporate headquarters, so that's a period cost. And it's the same thing for the president's salary. He or she doesn't make anything. They're the president of the company. So now we know that our manufacturing costs are our product costs, and our non-manufacturing costs are our period costs. Our period costs are going to hit our income statement right. For example, debit sales commission, credit cash. Debit president's salary, credit cash. Period costs hit the income statement in the period they're incurred. Whereas product costs hang around in inventory until we sell them, and then they hit the income statement. And we've decided that there's three different kinds of product costs. Direct materials, like the wood that goes into our surfboard. Direct labor, like the men and women who are hands-on making the surfboards. There's also manufacturing overhead. We somehow want to include that in the cost of our products. Indirect materials would be the wax that we put on the surfboards. Indirect labor would be the supervisor's salary. Other indirect costs would be things like the rent on the factory. Somehow we're going to have to figure out a way to apply this manufacturing overhead to our individual products as we make them. So in summary, when we're trying to figure out what it costs us to make our things, our products, any cost incurred inside the manufacturing facility is going to be a product cost. And that's going to be carried in our inventory. Stuff we're going to work on, stuff we're working on, and finally stuff we're finished working on. And it's going to hit the income statement when we sell it. Debit cost of goods sold, credit, finished goods inventory. Whereas period costs, things like sales commissions to our sales folks or the president's salary, are period costs, and they'll hit the income statement as we incur them. Debit sales commissions, credit cash. And the next thing we have to do is we have to divide our product costs up into three major categories: direct materials, direct labor, and manufacturing overhead. And we have to figure out how to apply those costs, how to track them as they go from the left-hand side to the right-hand side. And that'll be the subject of our next video.